Everyone, Douglas here, Kenner Market Analysis, and welcome to the weekly macro update for Sunday, September 8th, 2019. It's 11 p.m. on the dot Eastern Standard Time as we kick things off here. And we're going to just go and dive right on into things this evening, starting off with the macro triangle, which you can see on the screen, which is just my general assessment of where I think we're at within the macro economy and the most important building blocks to that, primarily with equity, the equity space in mind here. And this past week has turned out to be really a very positive week in terms of markets finally kind of aligning to where at least I thought they should be, given kind of the overall data set that I interpret, primarily what is in focus here in the macro triangle. So really good action happening, and I think we're even up 0.25% as just shy of 0.25%. So not too much action happening as the week, at least in terms of the futures market, start off. But all in all, very positive week, and I really think, as my conviction has been, that the underlying market conditions remain relatively strong. And I think what we're actually starting to see, and I'm going to kind of make this case tonight, I think what we're starting to see is really some developments into that late stage. You'll see that the private debt, which is really just kind of what I call the banking data, is flashing maybe some odd signs that I guess that doesn't necessarily indicate that we're going to get a rollover, but it definitely indicates that we are seeing some strain, and I think we might be in that environment where we're going to be very late stage, where we're going to get very speculative, and possibly some divergences occurring between some of these kind of underlying macro drivers that ultimately will create a slowdown down the line. And as we look at the employment data at the end too, I think there's some we're just getting to maybe some late stage signals. It doesn't have to be. The stuff can roll over. We can get another cycle occurring, another 6-month cycle, another pause, but definitely some things to start to look at. So let's dive into the raw data as it is and take a look. The first thing we're going to take a look at is the fiscal data here, and really big jump noticeable at the end of August. So we really caught back up at the end of August. In fact, we hit an all-time high in terms of average 365 days, or average yearly money creation, we'll call it, fiscal money creation. On that daily average occurred at the end of August. Over $20 billion daily on average is what's entering the economy, new money coming off the balance sheet from the Treasury and into the financial system. So good acceleration there. We were a little worried as August was kind of lagging behind where we were last year in expectations, but the big payments, the Medicare payments and the Social Security payments hit, and that put a lot of money into the economy. And there's that. We ended up essentially even from last year in August. We're only 3 reporting days into September, so I haven't updated these charts for September, but we continue to see good growth in the second half here, or the kind of the ending part here of the fiscal year. So again, that fiscal year ends in September, so we're now in the last fiscal month, and as always, we can get some reserve drains. Remember, when the government spends money, when the Treasury spends money, that goes into the banking system. That new money essentially becomes reserves, and those reserves have to do something. The banking system wants to do something with those reserves because of the pause that occurred last month in terms of excess reserves that have to remain on balance of banks. A lot of those reserves now are just sticking in the reserve category. So we've seen almost no shift in excess reserves. In fact, I might have that chart. Let me see if I can bring that up. Already loaded. You know what? Doesn't matter. I will bring it up anyway. We'll just go reserves and excess reserves, and this is the monthly chart. I know there is. Here we go. There's a weekly chart that gets updated. So as you can see, the excess reserves of the depository institutions have remained sideways for the last few months because of the big rule change. So really what this is actually doing, I mean, the big takeaway here is that banks are having a restricted you can't see my hands, a restricted zone in terms of how much money they have in there on their balance sheet that they're able to put towards risk assets, because that's really what we're looking for when we do this sort of assessment. What capacity do banks have to enter riskier assets? Because as they enter riskier assets, that creates growth in the economy. It's not good growth, it's not sustainable growth, but it's growth nonetheless, and that is, we want to be long at that point. Granted, that buildup is what builds the necessary conditions for the crash at the end of it, but in the meantime, that's what we want to see, is that buildup. So I mentioned this back when it happened a few months ago, a few weeks ago, that I think the pause here on excess reserves is a bad idea. I still think they should be able to drain, the bank should be able to drain the amount of reserves they have in the system, but realize this is now a reality, that we're going to see some constriction within the bank sector here with regards to that new money. So going back to the kind of original point, let me pull back up the fiscal data here. As this new money enters the economy, banks want to put it to good use. Unfortunately, right now, it's being put just into reserves as opposed to into any good use in the economy as they see. And again, this isn't, when I say good, I just mean good as it relates to equities. But all in all, still very strong base here from a fiscal standpoint. So going back to some more of that banking data now. Let's see. In terms of, let's start with, risk assets here. Yeah, in terms of risk assets, we continue to see a rollover here in risk assets, which, I mentioned last week. I'm just starting to get concerned here. I would like to see banks push more and more into risk assets if we're really going to see some sort of rally take off here. Until that happens, I'm still going to have just a tiny smidgen of doubt here in terms of what's happening. I do think it will happen likely next week. I definitely want to see a reversal there with regard to risk assets. However, on the flip side, and I talked about this a couple weeks ago, kind of my new favorite chart here, foreign assets are increasing, and since the vast majority of foreign makeup is risk assets to begin with, or riskier assets to begin with, I think this is a good sign as well that we're seeing a big takeoff here in foreign assets and almost back into year-over-year growth as opposed to year-over-year contraction. Again, setting up that I think we're getting into those elements of kind of some more speculative bubble style activity. And I say that primarily because of where interest rates are at right now, and because of where and because of the stopping of the bank reserve roll off as well. That just creates an environment where if you're going to be successful, you have to get risky, and we've been running so long now in terms of this business cycle that I'm sure banks are going to kind of position themselves. And then on top of that, 3 years into the Trump administration, a lot of his policies to end some of the Obama era restrictions on riskier business practices have also been put in place, and some of the actual regulations that were put in place have been rolled back. And so we're definitely seeing an environment that is more tolerant to risk, for better or worse. But obviously, we want to ride it on the way up and get out when the signal flashes that we need to on the way down. So, yeah, banking data. Again, I look at the foreign assets that look strong. I definitely want to see the domestic risk assets pick up. And I do think that we'll likely see this very soon, or at least we're seeing the earliest indications of this happening, because we are seeing interest rates start to pop up. And I do think that's what's going to happen. We're going to see bond prices go down, and we're going to see as that begins to happen, we're going to see then that banks are going to want to take on a little bit more risk, or at least that's going to be the signal that banks are ready to start taking on more risk and expand that part of their balance sheet. And we're seeing that, in fact, as it is, or we will see that, in fact, on this chart right here when it does happen, and that would be the Treasury and agency securities. So again, when we go to that physical flow chart, when the new money comes in, they have to make a decision what to do. Well, what we've been seeing banks decide to do is buy bonds with those since 2008, and you can see that here in this blue line. And when that finally stops, or at least starts to slow down, relatively speaking, that's when we'll know that banks are ready to take on some more risk. And I think we're seeing that already as bond prices start to roll off. All I have on here in this red line is the 10-year, the inverse of the 10-year, so essentially a bond corollary. So you can see the the similarity there in terms of the makeup. So all in all, I still actually think banking data remains relatively positive, or at least in a positive situation where we can expect to see equity growth in the coming future, and potentially even kind of that blow off top style nature emerging, which would fit very well with our count as it is. Switching here to the S&P real quick, as our count has us in that third of larger fifth wave, that at least going all the way back to the 2009 low, that we're in the later stages in our count. So yeah, we'll keep that in mind and see how this plays out. Let's look at sentiment real quick. Again, I still think sentiment sets up pretty bullishly relative to where I think we're at in the macro economy. We're still very kind of undervalued bullish wise from a sentiment, I guess you could say, and the bear sentiment's way too high. I think there's a big mispricing, if you will, in sentiment. Same with volatility. And one thing I'll point out too, momentum wise, a lot of money gets traded using just the 200-day moving average, the momentum trade. We're above that 200-day moving average. We've tested it a couple times now since we did break below back in December, and it seems like from a momentum standpoint, we're starting to emerge higher. So or just emerge or continue the trend that has emerged, I should say. Let's take a look at ISM. So the ISM number came out last week, and then following that, the non-manufacturing number came out, and it was a big, kind of a big. Well, actually, it signified a contraction in manufacturing as a whole, and this is definitely an important indicator to keep an eye on. It's a leading indicator for the overall economy. However, I think this has a lot more to do with the perception of the ongoing tariffs and trade war that the U.S. is having with China than it does with the reality of the economy as itself right now. I mentioned all that because late last week the non-manufacturing PMI number came out, and we saw a big reversal for the month and a big pop back up. So pretty much what this is telling me that kind of on the consumer retail side of things, and that retail data actually is the retail numbers are coming out on Friday this week, so keep an eye out on that or for that. But what this is telling me is that the consumer side of things, which is something that I've felt and mentioned many times in the past, is much stronger than say the manufacturing side of the U.S. economy. It's just in relative terms, obviously. It's quite obvious that we're a service economy, retail economy overall, but that the sort of weakness that you might expect before big recession or anything like that just isn't there, and still that the consumer the consumer can still kind of maintain this economy for a while longer. And I think actually this might be where we see the late stage emerge, as well as kind of the consumer maybe finally overextends themselves. So we'll keep an eye on this. I think this looked pretty darn good all in all in terms of kind of confirming where it is that I think we're at. And I'm pretty happy to see this number where it's at. Speaking about data that came out last week, we also had the employment data come out. And I know the non-farm payrolls is kind of the big number that people look at, and there was a bit of a miss there. It didn't really affect the markets when it was all said and done. In fact, we got kind of a big reversal off of it after initial selling. However, what I do want to take a look at is we are starting to see, and this is just another reason why I'm getting, I don't want to say concerned, but it does make me think that we might be getting to kind of the beginning stages of the late stages, as we are starting to see in the blue line here the unemployment rate year-over-year change start to tick up again. And this has happened before, and nothing's kind of come of it quite a few times. We've seen these cycles happen just to kind of give way. But what we're also seeing is, once again, kind of a tick up of average hourly earnings, right? So remember, what this tells us is that as average hourly earnings go up, and the unemployment level goes up as well, that firms or corporations are feeling the stress of the demand of the relatively high employment numbers, low unemployment numbers, and that wage pressure. And historically, and since we've really been in kind of the modern economy, the post-80s economy that we've had, that 4.5% level seems to be that kind of 4.5% level seems to be the zone that we want to take a look at in terms of that rate of change overall in terms of wages. So yeah, keep an eye on that. And also, obviously, if we start to see, acceleration like we did in 2006, 2007, that would be a worry. But still, relatively speaking, not quite there yet. And again, it is this big surge in wages that produce the necessary environment. And this is really when we see kind of the big run-ups in the market as well, when these are happening. Or when these events are happening too, just because of the dynamics of a large indebted economy. It's when it kind of feeds on itself upwards. So yeah, there's that. And kind of the overall assessment here is just going to be that we're starting to flash those first signs of true late stage kind of late stage building. And again, they can reset themselves with kind of moderation, or they can really take off like they did in the late 90s or early 90s, before 2000 and 2007, 2008. All right, last thing I want to look at for this update is going to be comparative inventory and oil. Haven't looked at this in almost 2 months, I think, since I last updated this. Let me go ahead and pull up that chart real quick. And here we go. So I've updated this. And again, all comparative inventory is, in fact, let me get back to that site because I think I do have it pulled up. All comparative inventory is, or all that I'm doing here is the model that I used, created by Art Berman, which I even think he developed it with someone else. I don't remember exactly who, but it's by Art Berman, and all he's doing is taking the U.S. weekly ending stocks of crude oil and petroleum products, averaging that together. So here's all the data, and I believe you can download somewhere on this site the raw data itself. Yeah, right here, going all the way back to 1990. So all it's doing is taking the 5-year average and subtracting that from where we're at today. And so that's it. That's all it is. It's just the inventory levels, 5-year average of where we're at today. And that gives us the comparative inventory chart that you see on your screen right here. And as you can see, there's a big inverse correlation between essentially the build of inventory and the price of oil. So the blue line here is comparative inventory. So as you get essentially a decreasing inventory, that is going to kind of promote a more higher price in oil, and then obviously vice versa. As you get big buildups, that's going to push oil prices down. And as you can see in the zoomed in chart here, and we kind of want to always do our analysis relative to the most recent time that we were in this kind of comparative inventory zone. You'll see what I'm saying. But we are at almost essentially zero, we'll call it comparative inventory wise. We're actually at like 4,800. So the last time we were near the zero line was May of 2019. And the price level at that time was just slightly higher, about $6, slightly higher than where we were at today. And then you'd have to go all the way back to early 2019. We hit that same level, and that was coming off of the big sell-off that occurred from October into that time frame. And then if you go even further back, we had a similar point back in October, and we were much higher priced. So here's a scatter plot. Whoops, if I can find it. Here's a scatter plot of all those data points right here, and you can see the August 30th. I will go ahead and fill that in red so it will stand out. But right here is the August 30th data point for the most recent print, and it seems like, generally speaking, we are maybe appropriately to the lower priced end of this current cycle. And I think what's more important, though, is overall it does seem like we're starting to see a consistent trend downward in build. So my guess here is, I think, as it stands right now, we're probably about correctly priced. I'm going to switch back over to the oil chart real quick. I think we're, here we go. I think we're properly priced at 57 where we're at. Doesn't seem too far off. But I'm starting to lean towards a possible breakout here just based on the overall trend. If I had to put, place money on it, I think we could start to maybe carve out this blue count here and then go into some sort of triangle pattern over the next, potentially, if this were to play out, quite some time, actually a year or two, but at the very least in the short run, I think we could see a little bit of pop here. My conviction level is pretty low. Again, there's no major mispricing here as it stands, so I'm probably not going to play it, but I did want to take a look at oil and say that, there's kind of some increasing evidence that this alt count here, of at least a brief pop here, maybe get back above 60, maybe even all the way up to 70, seems like a higher probability than it did maybe 6 months ago or so. So again, I think we're properly priced, and I'm not, nothing that I want to play. There's nothing just really standing out on this chart yet, but I did want to take a look at oil, where we're at, and give that assessment there. So yeah, that's where I stand right now. I do think too, if we do start to see that trend pick up, or really pick down, if you will, in comparative inventory, and we continue to see kind of global demand increase near the end, that's the sort of setup we'd want to see, or at least a sort of kind of narrative, if you will, that would play out that I think could take oil higher here, if that were to be the case. So yeah, as it stands, that's kind of where we're at. One final thing in terms of kind of where I'm at in terms of my portfolio over here on the side, I'm going to continue to remain strong in that equity position for the time being. Pretty happy that I've kind of just gritted through it. Obviously, probably the most disappointing trade that I've had in the 3, almost 4 years now that I've been doing Canon publicly would probably be that TMV trade, the short bond trade. Obviously, that's gone against me. I'm going to hold it at least for the kind of current kind of sell-off that we're seeing right now in bonds, and try and get back some of my losses here, and then probably end up licking my wounds, because I really think the big play going forward is that dollar breakout. And I would like to put a little bit more money in there. I think if I had just pure cash on the side, I probably would just go ahead and put that towards the long dollar play, just to balance out the portfolio here, and not do anything short bond. But I do think there is a chance that bonds could drop here, especially if equities continue to churn higher. So yeah, that's kind of my assessment as it stands right now, and in terms of kind of my whole composition of the portfolio. But overall, obviously, equity is looking very strong, and I'm quite happy to hold a pretty large position there going forward, and just kind of no reason for me to budge at this point, because I really think that that's going to be the most profitable, kind of easiest play going forward. So anyway, that's where I'm at this week, and kind of what I'm seeing going forward. So yeah, good trading for this upcoming week, everyone, and we'll see you next time. Bye-bye.